Good afternoon, sir. You can hear clearly.
Great, thank you. Did you have a good lunch? Hope everyone had your lunch. Okay, do you have any questions from what we have discussed so far? Just to see whether there are any questions to be answered. No questions. Okay, then since no questions, I think we can proceed with where we have from where we have stopped. And hope you got some sort of an idea about finance, management accounting, and financial accounting. If I recap a bit, finance is how you source your business, how you finance your business. And once the business is formed, the business need to take its operations, and how that internal management of that business is happening is controlled with management accounting. And financial accounting is simply the preparation of final accounts to communicate stakeholders about the performance of the company, the position of the company, cash flow of the company, the equity transaction of the company. So business position and performance are being taken care by financial accounting, whereas business operations are being taken care by the management operations, but business is formed, how it is being financed is come under finance. So that is the connection between finance, financial accounting, and management accounting. And as I said, we will start off with financial accounting from the tail, and then we will discuss management accounting, and finally we'll touch a bit on finance, how the cost of finance can be calculated, and small stuffs there when it comes to finance. Right, now the introduction to financial accounting. So I have created this PowerPoint. I can share this with you all as well. If you can send me the email address, or I will, if not, I will send this to Indranil sir so he can distribute it to you all. Financial accounting. Okay. Accounting can be explained as a process of providing information required by the interested parties of a business for their decision making. Accounting can be explained as a process of providing information required by the interested parties of a business for their decision making. Financial information is very important in decision making in a business. Accounting that mainly provides financial information is called financial accounting. Accounting that mainly provides financial information is called financial accounting. I will share these PowerPoint slides with you, so don't worry about writing down the content that is available here. But if you have anything extra, you can write it down. Financial accounting is a process of recording, analyzing, summarizing, and interpreting financial transactions. So if someone asks what is the definition of financial accounting, yes, it is a process of recording. You record the financial transactions. Once record, you analyze the financial transactions, and then you summarize it and interpret it. So recording, analyzing, summarizing, and interpreting financial transaction is called financial accounting. Now here you can see a prominent figure in accounting. Can someone identify this person? Can someone of you identify this person? Any guesses? No. This is the father of accounting. This is the father of accounting, and he is Luca Pacioli. Luca Pacioli. And in 1494, he introduced the double entry concept in accounting in his book Summa di Arithmetica di Geometrica. And he is an Italian priest, Luca Pacioli, introduced the duality concepts in accounting in his book Summa di Arithmetica di Geometrica, which is the first step, or which is the emergence of modern accounting good 500 years ago, 1494. An Italian monk, Luca Pacioli, is identified as the father of accounting. Objectives and need of accounting. Why we need accounting? To know whether the business has earned an adequate profit. To know the profitability, we need accounting. To know whether the financial position of the business is sound. To know the financial position. So two main objectives of financial accounting is to know the performance of the organization, that is the profitability, and the position of the organization. Financial performance and financial position are the two main objectives of financial accounting. And to fulfill legal requirements, yes, you need to have a proper financial accounting in place in your organization, because it is legally governed to safeguard stakeholders of a business. And to minimize disadvantages arise through omission and commission of transactions. So you have to follow the accounting principles, accounting policies, and accounting standards to ensure financial transactions are recorded properly to achieve the business objective of knowing whether knowing the financial performance and the position of the business. So those are the main objective of financial account. Now then, let's talk about business transactions in accounting. Because when it comes to accounting, we consider the transaction that can be measured in terms of money. So accounting transactions should have a monetary term or monetary value. Other transactions are not accounting transactions. So let's read out. When a business carries out its activities, it requires to exchange resources with various parties. For example, when a business purchases goods on cash basis, cash and goods are exchanged between the business and the supplier. Accordingly, a transaction can be identified as an exchange of resources between a business and other party. So basically, transaction is an exchange of resource between a business and other parties. In a business, there can be various types of transaction. Among those transactions, the transactions of which their value can be measured in terms of money are considered in accounting. So that's the most important phrase here. The transaction of which their value can be measured in terms of money are considered in accounting. For example, you have a transaction, and the transaction is that you share your let's say pens. It doesn't come with any monetary value, then it's not a financial transaction. Okay, you give some sort of a gift from your personal money, or you give some gift that you have, which is of no connection to the business, or doesn't carry any monetary value, is not considered in accounting. So accounting always comes with a monetary value. So sale of good for 100,000. monthly salary payment of 50,000, obtain a bank loan of 300,000, electricity payment of 5,000. So everything here stated comes with a monetary value. So that is considered in accounting under business transaction. So accounting transactions always comes with a monetary value. Is very straightforward. Then we need to see the different elements in accounting. So once these accounting transactions are happening, there are 5 different types of elements that arise because of these financial transactions or accounting transactions. Those are called assets, equity, liabilities, income, and expenses. So every transaction in this accounting world comes under these 5 categories. Every transaction in this accounting world comes under it. Accounting world has to be part of an asset, equity, liability, income, or expense. There isn't anything other than these 5. So therefore, when we understand financial accounting, it's very important to identify whether it's an asset or an equity or a liability or an income or an expense. So that understanding is what we are going to create in this classroom. So first thing is to understand the type of the transaction or the impact of the transaction. So whatever these accounting transactions, there has to be an impact on these 5 different elements, and no other element will be available. So now we discuss about assets, we discuss about equity, we discuss about liability, income, and expense when we were discussing the accounting terms that you all know. But let's discuss about these 5 elements or categories in detail here. Please raise any questions if you have, because now we are following these slides. Assets. Now we all knew assets, right? Okay. Now when we say assets, then I'm pretty sure that you all get different types of assets. For example, land, building, machines, then furniture and fittings, then cash, bank account, fixed deposit, debtors, all are assets. That's absolutely correct. Here we are going to define the term assets. We are going to define the term assets because now you all know what are the available asset for a business. Now, if you look at our business, Pizza Hut, let's say our business is Pizza Hut. Now we establish a business to sell pizza. Now, when it comes to a Pizza Hut, then what are the assets that we can see? Now, if you think about a Pizza Hut, now if I ask this question from you, if you think about the pizza shop, can you name a few of the assets that are available in the pizza shop rather than I'm saying everything here? Can someone unmute and share a few things or assets that you can see in a pizza shop?
Pizza oven.
Pizza oven, fantastic asset. Yes. What else? Now we have one asset, oven. What else?
Building, vehicles,
Building, motorbike, right? Motorbike.
Motorbike.
Yes.
The technology or the theory of how it's doing, that's also asset. No, sir. The
Sorry,
methods, how you are going to doing the thing, or maybe some.
do you have a
say-
value for that? Can you give a monetary value for that? Now we
suppose
say
if we are having, I-
okay, please go ahead.
if we are having some smart technological software or something to do everything instead of manual, automated manufacturing production,
Okay,
that also can be taken as the asset. No, sir. Can it?
can we sell that to someone else and convert it to money? No, I think, right? Is it possible? It's not possible, I think. So we only consider financial transactions and that produce business value for a longer period of time, or let's forget about the time, and convert it to cash or cash equivalent. But the pizza shop may have a laptop or a computer, right, to run a business. That is an asset. What else? Oven, building, motorbike, computer, tables and chairs. Yes. What else?
So land,
Land. Yes. What else? Cash. Bank account balance. Right? Do you see anything else?
sir, supposed to tell the same cash in hand and the
Bank.
bank deposit.
Okay. Yes. Now you know what are the assets. That's very good. Now let's look at the definition of assets, and think of one of the assets that you said: oven, building, motorbikes, computer, tables and chairs, land, cash, bank. These are the assets that we discuss, and let's see whether they comply with the definition of assets. An asset is a resource controlled by the business. Very important. Resource controlled by the business means the ownership should be with the business. Now, if the land is a rented or the building is in a rented premises, then it is not belongs to us. So we can't consider that building as an asset because we have rented out that building. It's not my asset, it's our owner's asset. Okay, the property owners. So an asset is a resource controlled by the business. Ownership should be with the business. So oven, yes, ownership is with us. Building, if we own the building, yes. If we do not own the building, no, that is not belongs to us. Motorbike, yes, it's belong to us. It's our motorbike. But if we hire a rider who owns a motorbike, can he or she is using his or her motorbike to transport pizza, then it is not belongs to our business. But yes, if we own the motorbike, yes, it is our asset. Computer, yes, it's part of our business. Tables and chairs, yes, we have owned tables and chairs. Land, if not a rented one, yes, it's our own. If we have rented the building, the land obviously not belongs to us. Cash, And bank, yes, it's our bank account, it's our cash, so they belongs to us. So just apply that. The resource controlled by the business as a result of a past transaction. It occurs as a result of a past transaction. Now, oven we have purchased. We have purchased, so that belongs to us. So we have the ownership. So that ownership came because of that purchase. And purchase happened as a past transaction. Motorbike, yes, we purchased the motorbike. Past transaction. Computer, yes, we purchased that. Tables and chairs, yes, we purchased that. So it has already happened and created the resource that we own as a business. So an asset is a resource controlled by the business as a result of past transaction and from which future economic benefits are expected to flow to the business. So those assets will bring us future economic benefits. Oven, without oven, we can't cook pizza. So it will give us the revenue. Building, without the building, we won't have this pizza shop. It provides future benefits. Motorbike to sell pizza, provide future economic benefits. Computer is a system that runs and all the promotion sales are happening using that. So it provides future economic benefit. Tables and chairs, people cannot eat without them and provide future economic benefits. Land, yes, that's why we have the pizza shop, provides future economic benefits. Cash and bank, yes, which is being utilized to run the business and of course provides the future economic benefits. So asset is a resource owned by the business, controlled by the business as part of the past transaction, as a result of past transaction, and from which future economic benefits are expected to flow to the business. Very straightforward. And now the characteristics of an asset arose as a result of past transaction, controlled by the business, and inflow of future economic benefits to the business. The definition has all the characteristics of assets. So then now you can map the different types of asset to this description. And then the assets of a business can be categorized into two types as follows. There are two different types of assets can be seen in a business, and you know these two types. It's current assets and non-current assets. Current assets and non-current assets. Very straightforward. Now let's look at the definition. The assets that are expected to be used, sold, or converted into cash within a short-term period as 12 months in the ordinary activities of a business are classified as current assets. Assets that are expected to be used, sold, or converted into cash within 1 year are called current assets. ඒ කියන්නේ අවුරුද්දක් ඇතුළත මේ assets එක්කෝ විකුණනවා, එක්කෝ පාවිච්චි කරනවා, එක්කෝ cash වලට convert කරනවා. ඔය තුන තමයි කරන්න පුළුවන්. For example, stocks. Now, let's say we have flour, wheat flour, palm piti. We bring in kilos. Let's say we bought 200 kilos of flour, but we are not using them at once. We use 200 kilos of flour, let's say, for 3 months' time. So we kept them as stocks, which is an asset. But we know for a fact that it will be used to make pizza. So that is current asset. Let's say we have sold 50 pizza to another business organization, and from them we are to receive, let's say, 500,000 rupees in another 1 month's time. So that is a receivable. So that will convert into cash in 1 month's time. So that is current assets. So assets that are expected to be used, sold, or converted into cash within a short period of time, that is 12 months or 1 year, in the ordinary activities of a business are classified as current assets. Your bank account, you will be using that continuously. So it is a current asset. The non-current asset, all the assets that cannot be considered as current assets are considered as non-current assets. Current asset නොවන සියලු asset non-current assets. කෙටි කාලීන වත්කම් දිගු කාලීන වත්කම් කියලා තමයි ඉස්සර කාලේ නම් ඔයාට කිව්වේ. Non-current assets, land and building. Again, land and building. Company owns that. Rise due to past transactions and will provide future economic benefit. And there is no intention to be used, sold, or converted into cash within a short period of time in the ordinary activities of a business. So land will not be converted into cash within a short-term period. But on contrary, on the other hand, if the business is doing buying and selling lands, then we may not say it as non-current asset. Okay, there is a business. What they do is buying and selling lands. It's not a non-current asset. Land and building, machinery, furniture, equipment, motor vehicle. These are non-current assets. Now, let me classify one interesting thing here when it comes to asset. There are two businesses. One business is called Singer Sri Lanka. The other business is Shanta Stores. Okay. Singer Sri Lanka is doing buying and selling electronic items. Singer Sri Lanka is doing buying and selling electronic items. Shanta Stores is a retailer selling grocery items. And today, Singer Sri Lanka is having a refrigerator worth of 200,000. As well as Shanta Stores is also having a refrigerator of Can you all hear me? Power went off. Can you all hear me?
Can
Fantastic. I think sharing has gone, right?
Yes, sir, we can hear, but your screen is not visible.
Yes, let me share my screen. Let me know when you can see the PowerPoint.
Yes, sir.
You can, right? Okay. Now, the example says two business entities. One is Singer Sri Lanka, the other one is Shanta Stores. So today, Shanta Stores is having a refrigerator worth of 200,000, and Singer Sri Lanka is having a refrigerator worth of 200,000. So my question to you is, what kind of asset this refrigerator for Singer and for Shanta Stores?
For Shanta, it's non-current asset. For Singer, it's current assets.
Absolutely correct. Thank you. Yes. For Singer, they have purchased this refrigerator for selling purpose. And it is part of their stocks. It is part of their stocks. It's a current asset. But for Shanta Stores, refrigerator will provide economic benefit for years to come. And it is a non-current asset. It is a non-current asset. Clear. Then liabilities. Payables of a business that has arose as a result of past transactions could be simply considered as liability. Again, payables of a business that has arose as a result of past transactions could be simply considered as a liability. So here, there is a transfer of future economic benefit. Transfer of future economic benefit occurred as a result of past transactions, which is in a form of a payable. So arose as a result of past transaction, outflow of economic resources when settlement is made, and having a current obligation. So in a liability, there is a current obligation occurred as a result of a past transaction, and there are going to be an outflow of economic resources when the settlement is made. That is liability. And liabilities are very clear. So if we take a bank loan, let's say we take a bank loan, then we took a bank loan. So it occurred as a result of a past transaction. And then there are going to be a future outflow of cash to settle that. Future transfer of economic benefit to settle that. And right now we have an obligation. We have an obligation. Right now there is a current obligation. That is liability. And liability is also twofold. That is current liability and non-current liability. Current liability and non-current liability. Same explanation. The liabilities of a business can be considered into two types as follows. Current liabilities, non-current liabilities. Current liabilities, the liabilities that should be settled within a short period of time, as within 12 months are classified as current liabilities. These are also termed as short-term liabilities. Creditors that arose when goods are purchased on credit for resale. Accrued electricity expense, accrued water expense, accrued telephone expense, whatever are called liabilities. Non-current liabilities, all the liabilities that cannot be classified as current liabilities are considered as non-current liabilities. The portion of a bank loan that needs to be settled after 1 year. So let's say we take a bank loan and the loan repayable period is 10 years. So the first year of payment or current year liability is a current liability, but the liability beyond that is a non-current liability. Let's say we are at the inception of the loan. We just started, we just took this 10-year loan. Let's say loan amount is 10 lakhs and every year we have to repay 1 lakh. Hypothetical example. So 1 lakh is the current liability and 9 lakhs is the non-current liability. And we are moving on to the next year. So 1 lakh is the current liability and we have already paid 1 lakh. So 8 lakhs remaining. So 8 lakhs is the non-current liability. So that's how liabilities are being termed. It's our obligation to transfer economic benefit that arose due to past transactions. And there is a future economic benefit outflow at the settlement of the liability. Then equity. So we now discussed about two different terms: assets, liabilities, and now equity. Assets, liabilities, and now equity.
Excuse me,
Yes.
sir, under assets, is there any clarification as fixed assets and variable assets?
No. Variable assets, fixed asset? No. It's current assets or non-current assets. Or non-current asset is also called fixed asset. No variable asset. Okay.
Okay, thank you.
Excuse me, sir. Is there any difference between liquid asset and current asset?
Liquid assets and current assets. Yes, current assets are the most liquid assets.
Okay.
You can liquidity means how fast you can convert into cash.
Cash. Okay.
And the current assets are the most liquid asset. The most liquid asset is cash.
Okay. Okay. Thanks.
Because cash is cash. It doesn't require to convert into cash.
Yeah.
So cash form is the most highest liquid form actually.
Okay. Okay. Thanks.
Great. Thank you. Please raise questions. That's great. Equity. Variable asset. Variable cost is there in management accounting. Equity. If the business has liabilities, a part of its assets has to be used to settle those liabilities. After the settlement of such liabilities, the assets that remains belong to the owner of the business is called equity. Now, equity is, in a very simple term, the assets, the value of the assets that belongs to the business. Equity is the value of assets that belongs to the business. The value of assets that belongs to the owner of the business is termed equity. And there is an easy way to understand this. Let's look at this example. Let's assume that a business has 500,000 worth of assets and a bank loan amounting to 200,000. Business එකක් තියෙනවා. ඒකේ assets තියෙනවා 500,000. ඒ වගේම loan එකක් අරන් තියෙනවා business එක 200,000. So then what is the equity of the business? In the definition, it says value of the assets that belongs to the owner of the business is termed as equity. Value of the asset. Now here, your asset value is 500,000. But you have a liability as well. Liability as well, that is 200,000. So the equity definition says, if the business has a liabilities, a part of its asset has to be used to settle those liabilities. And then whatever the remaining belongs to the owner. So business has 500,000 worth of assets, as well as business has 200,000 liabilities. So once the liabilities settled using the assets, the remaining amount is the equity. In simple term, equity is equal to asset minus liabilities. So the owner's equity here is 500,000 minus 200,000, 300,000. That is owner's equity or equity. එයාගේ හිමිකම තමයි ලක්ෂ 5. company එකේ වත්කම් asset තිබ්බ ලක්ෂ 3 හිමිකම ලක්ෂ 3 company එකේ assets තිබ්බ ලක්ෂ 5ක් ඒ වගේම company එකේ වගකීම් තිබ්බ ලක්ෂ 2ක් එතකොට company එකේ ownerට කොච්චර තියෙනවද හිමිකමක් මේ business එකේ එතකොට ලක්ෂ 5ටම හිමිකමක් තියෙන විදියක් නැහැ මොකද වගකීමක් තියෙනවා ලක්ෂ 2ක so you have to settle that liability first එතකොට ලක්ෂ 2 settle කරන්න assets ලක්ෂ 2ක් අයින් කරාම අපිට assets ලක්ෂ 3ක හිමිකමක් තියෙනවා ඕනට so that is equity the value of assets that belongs to the owner of the business is called equity and how that is being calculated you have to settle all liabilities using asset and if there is a remainder if there is a remaining asset that is the one that is belongs to the owner of the business and that is equity income and expenses let's drink some water right income and expenses income means in sinhala ආදායම් expenses in sinhala වියදම් so you take all of your income and you take all of your expenses and what is remaining is the profit now let's say this is again not true accounting sense but just to give you this understanding you don't have any amount right now and now today you find a good job and after 1 month's time you are getting your salary 100,000 let's say that is your income and then within that month till you are getting your next salary you are spending that 100,000 and now we have spent 80,000 of rupees within that 1 month time so your income for that period is 100,000 and your expense for that period is 80,000 so your profit is 20,000 it's not profit actually but when it comes to a business within a month or within a year what are your total income and then what are your total expenses so you deduct your expenses from your income to figure out the profit of the business in a very simple term so profit of a business is the difference between income and expenses so income minus expense and the profit belongs to the owner of the business because profit is always belongs to the owner of the business and profit will increase owner's equity owner's wealth higher the profit that will increase the wealth or the equity of the owner therefore profit must be added to the equity profit must be added to the equity because profit belongs to the owner of the business therefore income can be defined as an increase in equity income will increase the equity due to the increases from income can be defined as an increase in equity except due to the increases from capital introduced by the owners so you can ignore that part but income will increase the equity whereas expenses can be defined as a reduction in equity expenses will reduce the owner's equity income will increase the owner's equity there is an exception except due to the increase from capital introduced by the owner or drawings, we will touch that later. So for example, income, sales income, interest income, rent income, commission income. So all these are income types, and they will increase the owner's equity. And expenses could be, we can see 1,001 different types of expenses in businesses, like salaries, wages, insurance, water, electricity, cost of goods sold, and so many different types of expenses in a business organization. And when you look at these annual reports, you can see different types of expenses in those annual reports. You can see different types of expenses in annual reports. They are clearly mentioning about expenses. If I open up this Amana Takapul annual report, let me try to figure out different types of expenses. Let's say expenses. Let me see whether I can figure out different types of expenses here. Just trying to figure out. It's under notes to the financial statements. We have financing expenses, note 5, financing expenses on due to other customers, expenses on other liabilities. Then we have personal expenses. We have depreciation of property, plant, and equipment. Personal expenses are discussed under note 10. And salaries and bonuses, defined contribution plan, ETF, EPF, defined benefit plan, gratuity, other staff related expenses are coming under that. And then other operating expenses. Other operating expenses are discussed, are categorized as directors remuneration, auditors remuneration, audit fee and expenses, non-audit services, professional and legal fees, office administration, establishment expenses, advertising and promotion, deposit insurance premium, system support fees, other expenses. And those are the main types of expenses. And note 25 discussed about depreciation.
Excuse sir, we can see the report.
No, it's a physical one I'm
Okay.
reading.
Okay.
Yes, yes.
Sorry. Okay.
So depreciation expenses, taxes, tax expenses, different types of tax are being discussed there in the report. current tax expenses, provisions, deferred taxation, income tax expenses for the period. So as you can see, there are a lot of different types of expenses when it comes to a business, and also there could be different income sources as well. Different income sources. So when it comes to this Amana Bank, they have financing income mainly. So they are since it's a bank, it's financing income, then commission income, net trading gain, operating income, net fees, and financial income accrued, placement income. So there are few income sources, but there are a lot of expenses, financing expenses, other expense on liabilities, tax expenses. So if we think of a manufacturing organization, so this is a service organization. So there could be more income and expense types. Right. Now, you know about these 5 different categories: assets, liabilities, equity, income and expenses. Assets, liabilities, equity, income and expenses. So now you all know these are the 5 types, and if you know these 5 types, then accounting is very straightforward. Now let's identify these different transactions, whether they are assets, liabilities, equity, income, or expenses. Okay, shall we try to identify these different accounting transactions? Right. First one, electricity expense. What is the type? You can unmute and say.
Expense.
It's an expense. Fantastic. Then commission received.
Income.
Income and equity.
No. There has to be one, right?
Okay, income.
Income. Sales.
Income.
Income. Advertising expense.
Expenses.
Expense. Bank loan.
Liability.
Liability. Non-current liability. Let's say if it's a long-term loan, non-current liability. Capital.
Asset.
Asset. What else?
Equity.
Equity. That is what owner is putting into the business. So it belongs to the owner. Okay. It's equity. Creditor.
Liability.
Liability. Creditor.
Asset.
That's it.
Asset. Asset. Creditor. Asset or liability. Or income or expense or equity. Creditor.
Liabilities.
Liability. Trade.
Income.
Income. Yes. Now some says income. Some says asset. Some says liability. Income.
Now, sir, creditor has to define creditors of the company, or we are creditors of their. In that sense, it has to
No.
go to
For a business, there is only one creditor types. Now we are thinking of a business. Then creditors are asset, liabilities, equity or income or expense.
liability.
Asset.
Asset.
Asset, liability, income. Now let me ask you, who are creditors?
Naya Himio,
Namihimi.
the liability.
Naya Himyo in Sinhala, yes. Now, who are creditors? Creditors. Can cow the creditors can cow the
අපිට ණය දුන්න මිනිහ.
අන්න හරි. අපිට ණය දීපු අය. Creditors. For example, if we take a bank loan, then bank is our creditor.
Creditor.
If we take a loan from Bank of Ceylon, then Bank of Ceylon is our creditor. ණය හිමියෝ. අපි යාලට ණයයි. අපි යාලට ණයයි නම් who are they?
Liabilities.
Liability. ප්‍රශ්නයක් යම බය වෙනවනේ. ඊට පස්සේ වෙන වෙනම කියන්න. Creditors are a liability. Commission paid. Commission fee
Expenses.
paid.
Expenses.
Expenses. Vehicles.
Assets.
Assets. Long-term asset or a short-term asset or a current asset or a non-current asset.
Non-current.
Non-current assets. Vehicle repair expenses.
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 Expense.
Now, vehicle is asset, so repair expense, expense.
Capital expenditures. I don't know.
Expenses. Again, expenses, right? Yes, it is an expense. Motor vehicle is an asset, but vehicle repair expenses, expense. And this is repair expenses. Now, say for example, if that expense is occurred, if the expense that occurred will increase the useful economic life of the asset or improves the efficiency of the asset, then it will be added to the vehicle and it will be a non-current asset. Let me explain. Now we have a motor vehicle for our business, okay? And every month we have to do our routine service by spending 30,000. Every month we have to do the service, and for that we are spending 30,000. So that is a running expense. Now we have used this asset for 15 years, and now the problem is that we can't use it anymore because engine is giving continuous troubles, and now the value of the asset is gone down drastically because of this engine problem. So what we are doing is now value of the asset is now 30 lakhs because of this problem. And now what we do now? We replace it with the modern latest engine, and that will cost 20 lakhs. And now it is not a running expense or repair expense. It is a capital expenditure will add the value of, improve the value of the asset. Now suddenly the motor vehicle value jumped up to 50 lakhs. And that is an asset, non-current asset that will be added to the motor vehicle. Then investment interest income. What is that? Interest income?
Income.
Income? Interest income? This is investment interest income. What is that?
Yes, income.
Liability.
Liability. Oh? What else? What else? Investment interest income? It is an income. Interest income. You have invested, let's say, fixed deposit or treasury bill or treasury bond, and you get your interest income, which is an income. So don't change Your answer if you are so confident, right? Debtors,
Assets.
assets. So creditors, liability, debtors, asset. What type of asset? Current asset or a non-current asset? Usually current asset. Usually current asset. Then interest paid on bank loan. Now we have taken a bank loan, a liability, and now we are paying the interest. What is that?
Expenses.
Now we have a liability. So interest is now paying. Is it an expense?
Yes, sir.
It is an expense. Yes. So now when you see different types of financial transactions, try to figure out whether it's an asset or a liability or an income or an expense or an equity. So that understanding is very important. Okay. Now you can see Enron, right? You can see a logo with its name Enron. What is Enron? What is Enron? Have you ever heard about a company called Enron? Enron? අහලා තියෙනවද Enron ගැන?
No, sir.
Anyone here?
US corruption involved.
US corruption. What do you know about what more you know about Enron?
Accounting frauds.
Accounting fraud. Okay, fantastic. So let me ask this question from you. Do you know the biggest company in the world today? In terms of revenue, the largest company in the world today in terms of revenue? Apple. Okay. What else? Without Googling, right? When you Google, then you know the answer. Largest company in the world in terms of revenue.
Microsoft.
Microsoft. Very good guess. Anything else?
Tesla.
Tesla. Not Tesla. Elon Musk Tesla. No.
Walmart.
Yes, the largest company in this world in terms of revenue is Walmart. And it is the largest company now for about 10 years. Last 10 years, it is Walmart. Okay. Do you know the most profitable company in the world? Without Googling? Most profitable company in the world. Profit. You take your income, you deduct all your expenses, you get the profit. So that profit belongs to the owner. So what is the most profitable company in the world today? I just want you to guess.
In Apple.
That's a very, very good guess. Almost there. Any other guesses? Any other guesses?
Facebook also doing the kind of revenue generating project, no, sir?
That is Meta, right? Yeah. No, they are very profitable, but they are not the most profitable company. But that's a good guess too. The most profitable company in the chat, there is an answer, not Facebook. Is Saudi Aramco. Have you heard of Saudi Aramco?
Yes, petroleum refinery.
Yes. Saudi Arabian government funded petroleum company. Saudi Aramco is the most profitable business in the world. Actually, before Saudi Aramco, it was Apple. And prior to Apple, again, it was Saudi Aramco. And because of this fuel crisis with the COVID, the petroleum prices went down drastically. And Saudi Aramco was the most profitable company, but then they lost their stake. And then Apple once again came back to the top position. But now with the Russian-Ukraine war, the oil prices have increased and the demand for Saudi Aramco has increased dramatically. So now again they are back in the business and is the most profitable company, way ahead compared to Apple nowadays. So Saudi Aramco is the most profitable company in the world today. And sometimes it's very interesting to know about these different businesses, and they have their fascinating stories, like how all these businesses started. Now when it comes to Walmart, the largest business in the world, how Sam Walton started in 1962. So they are charismatic leaders, and a lot of interesting things can be learned from these businesses and how they manage their business, and how they treat employees and stuffs like that. And certain cases, things are so inspiring. And Enron was an inspiring story, but of course not for Enron, but for us, because Enron was the most innovative company in the world from 1995 to 2001. Most innovative company. And this Fortune magazine, released by Time Corporation, every year they have a special edition called Fortune 500. They released Fortune 500 recently as well. So nowadays you don't need these printed materials, but you can Google and search, and you can pay a small subscription for Fortune to get the magazine for you. So it's available online. Fortune, every year they release a special edition called Fortune 500, which talks about largest companies in the world, most profitable companies in the world, highest grown companies in the world, most admired companies in the world, highest paid CEOs in the world, most emerging companies in the world, most innovative companies in the world. So a lot of business facts are included in that edition, and usually Fortune talks about businesses. And Enron was the most innovative company in the world, for 6 consecutive years, from 1995 to 2001. And in 2001, the year that they received the most innovative award for the 6th consecutive time, they collapsed. Enron collapsed. Very interesting. The most innovative company. It was in the energy sector, oil and gas sector, providing energy to a lot of business organizations. A US-based company, if I remember correct, sixth largest company in the world in terms of revenue, and the revenue was bigger than the Sri Lanka revenue. Enron revenue was bigger than the Sri Lanka revenue. By the way, do you know the revenue of Sri Lanka today? Or the GDP of Sri Lanka? No? It's somewhere closer to 84 billion US dollars. Now, if you look at companies like General Electrics, of course, companies like Walmart, their revenue is much bigger than the Sri Lanka. GE revenue is quite closer, but Enron revenue is not Enron. The Walmart revenue is, let me Google. Walmart revenue 2022. Now, Sri Lanka revenue is 84 billion US dollars. And Walmart revenue is 573 billion US dollars. 573. So, Walmart economy is 8 times bigger than the Sri Lankan, or 7 times bigger than the Sri Lankan economy. Just to tell you the size of the business. Walmart economy is bigger than the Sri Lankan economy. Walmart business. So, most innovative company for 6 consecutive years collapsed in 2001. And I want to touch about the business reality here. Business reality. Because it's very important to understand the business nature. When it comes to large businesses, when it comes to corporations, public or private, owners, public business, that is listed companies, right? Owners of the business are not managing the business. Most of the cases, public companies, but private companies, it's the same now. When it comes to my organization, that is IFS. So we have 3 owners, 3 investor companies. One is EQT, another one is HG Associate, HG, another one is TA Associate. So EQT owns 51% of the shares, HG Associate 29% of the shares, and TA has 20% of the share, TA Associate. That's how they have the ownership. So when it comes to a large businesses, owners of the business are not managing the business. Now, if you think of someone like Aravinda De Silva, the Sri Lankan cricketer, now a businessman, so he owns a lot of businesses in Sri Lanka, but he is not managing those businesses. And what he does is he recruits a competent set of managers to run the business, and the people that he trusts will come and manage the business, and those leaders are called the leadership teams: CEO, chief executive officers, chief financial officers, chief technology officers, chief HR officers, chief marketing officers, chief custom officers. So all the CXOs are part of the leadership team, and they are hired employees. CEO is a hired employee, right? Employee hired by the owners. So owners are there, they invest their money on businesses, but the managers will run the businesses. That is how the businesses are running. And think of your business as well, businesses as well, organizations as well. Now, there is always a conflict here because it's not the owner is managing the business, but someone else on behalf of the owners is managing the business. And there is a conflict which is called agency problem or stewardship problem, because owners are investing for businesses to get higher profit. Higher profit. Owners need profit. Owners ලාට ඕන ලාභ. And they select competent set of people to run the business, and managers, the leaders, should showcase higher profits to the owners because owners needs profit. Owners needs profit. So the CEO and their colleagues, leadership teams putting a lot of effort to increase the profitability of the business. And their benefits, their perks are depend on how well they are running the business. එයාලගේ benefits, එයාලගේ salary, එයාලගේ bonuses depend වෙන්නේ business එකේ profit එක වැඩිවීම මත. If the owners are happy, then they will increase these key employees benefits, salaries, perks, benefits. Everything goes very smoothly when the business is performing very well. Everything runs so well when the business is performing very well. But the problem arises when the business is not doing well. When the business is not doing well. So when the business is not doing well, these executive officers are trying to manipulate the profit. They can inflate the profit, they can inflate the asset base, and they try to showcase a falsified picture to the owners to maintain their perks and benefits. That's quite natural in this business world. But owners can't do whatever they want. Sorry, not owners. These leaders, CEO and his colleagues can't do whatever they want. And the owners are protected. How they are protected? They are protected by the accounting standards. They are protected by the auditing standards. They are protected by the legal framework for business entities. So they are protected. They can't do anything. But the problem is, these owners, they don't know accounting. They don't know auditing. They don't know anything about accounting standards, financial reporting standards. Because they are businessmen. They are not accountants. They are not qualified in accounting and finance or auditing. So, owners can still inflate the profit by making adjustments in accounts. Still inflate the revenue. Still inflate the asset base by showing a falsified picture, by doing window dressing, by removing transactions. Owners can do it. Again, to avoid that, there is someone called external auditors, independent third party that has the capability to run an audit and examine all the accounting transactions of a business and provide an audit report to the owners of the business. So what owners do is basically they step into the audit firm. Hello, audit firm. I have a business. Can you please come and audit my business and give me your audit opinion in a form of a report? Yes, absolutely. So we will go to your business. We will look into all the books. We will verify all the transactions and we will provide our audit report. And we are well-reputed audit company. And we have done 1,001 audits for large business organizations. So give that the responsibility. We will do your job. And you can pay us this amount of money for our services. And they get a lot of money from that, okay? Now, the interesting story is this. Enron, most innovative company for 6 consecutive years, 6th largest company in the world in terms of revenue, was audited by the largest audit firm in the world by that time called Arthur Andersen, largest audit firm in the world. But unfortunately, this CEO and his colleagues, CEO is Kenneth Lee Lay. Actually, he was the founder of Enron, later become the CEO of the company, Kenneth Lee Lay. Remember the name. They bribed auditors. They bribed Arthur Andersen, the largest audit firm, and they have issued a falsified audit statement as well. They have inflated all of their asset base. They were in the energy sector. They have showed oil rigs in the books where actually there were no oil rigs for them actually in physically. They manipulate the asset base, they manipulate the profit. But finally, when the things are figured out, it was too late and Enron collapsed. And in the meantime, Arthur Andersen also collapsed. Do you ever think someone else would step into Arthur Andersen, the biggest audit firm by that time, and request an independent audit opinion? Their independence was questioned in front of the courts. And today, we don't see Enron as well as we don't see Arthur Andersen. One of the largest corporate scandals in the world and one of the most attractive corporate collapses in the world, Enron case. And there are a lot of internal control systems emerged after the Enron collapse. US specific Sarbanes-Oxley Act to protect the owners emerged, which contains the internal controls of an organization and how organization should be managed. So it was an eye-opener to the business world. And after that, accounting standards, financial reporting standards were tightened to safeguard the owners of the business. Because, if owners' trust or the credibility is affected, no one would invest for a businesses and no one would trust their leadership teams to figure out whether they are running these business in accordance to the accounting standards. So Enron is a classic example to showcase the business reality. And after that, a lot of rules and regulations implemented. And nowadays, it is not easy to get rid of those standards. Easy to find loopholes. I'm not saying there are no loopholes, but a lot of loopholes were addressed after this Enron collapse. One of the classic business failures in the world. That is the reality. And there are a lot of examples we can take in Sri Lanka as well. One for sure in the banking industry. This bank manages taking small amounts from every transaction. It's not big amounts, like 3 rupees, 4 rupees from every transaction. This happened quite a long ago. So let's assume that in a bank, 10,000 transactions per day, salary payments, interest payments, bank-to-bank transfers, check realizations, fund transfers, 3 rupees from every transaction. Let's assume 10,000 transactions per day means 30,000 rupees per day, 30 days per month, 9 lakhs you are earning without doing anything, taking small amounts. And even if someone realized that, okay, my 3 rupees from my transaction is taken out by someone else, we are not worried. Why? only 3 rupees. Who cares? So that's how it has happened, but it got revealed and he was taken in front of the court and penalized. But that is the business reality. If there are loopholes, there are plenty of people to take the advantage. And accounting arena is so critical in that because accounting is the field that deal with the finance transactions, financial numbers. So it is very important to protect the accounts, protect the way of handling accounts, and have a good understanding about what sort of transactions that could occur to minimize the risk of an organization. So a lot of standards are there, a lot of rules and regulations are there, but still there could be loopholes. But the idea is to make it zero, no loopholes. So that is the Enron story. And then we talked about the agency problem. Yes, the principals, the owners are the shareholders, managers act as agents. So there is an agency conflict always. And auditor is the independent third party, qualified people who do the auditing process to secure the business organizations. So then we have to go to the entity concept, but it would be good to take a break before we move on. Shall we take a break then? Or do you have any questions?
So now the things that you have exaggerated on the Enron company and their owners and everything
Yeah.
is very valuable. If we can have a short note or something, whatever you are referring, if we can share or if we come to know that one is very difficult, very good because we see only that Enron logo only. What you are telling so much thing for us. It's very valuable.
It's just a matter of type Enron scandal in Google, you will get the entire story. Yeah, very straightforward. That's for your information actually. Will not be asked at the exam, but you to understand the importance of accounting and governance for any organization. Okay, so all the required material I'll be giving, but these are just to enrich your understanding, I would say. Great, thank you. Anyway, that's a good thing. But if I had time, probably I can drop you a small note about Enron, an auditor's responsibility. Anything else? Shall we take a short break and come? What's the time now? 4:30. We'll have then 1 hour further discussions. Shall we come at 4:30 then?
Okay, sir.
Okay, sir.
Okay. Thank you. So I will stop sharing. And if you have any questions, just make them ready so that I can answer when we meet at around 4:30.
Buồn chán nè ba. Rồi bị trẻ con đó. Vậy tôi đang bị trẻ. Vậy tôi đang mau đi cái mà mình tới cái đời mình අපි කට්ට කාගෙන ඉන්න දුන්න අපිට මරන්නේ නැහැ.
ඉන්න දැනක් නෑ. ඒක රෝග කියන්නේ. හරි වෙන මොකද කියලා
කොහෙද තියෙන්නේ? අපේ දෙවියන් හරි ඔයාලා ඉඳලා තියෙන පස්ස ඔයාලා ඉඳලා නැද්දි?
එතකොට තමයි වෙලා හොඳ. දැන් යකෝ ඉන්ටර්නෙට්
නෑ. කොහෙන්ද?
දැන් නම් ඉන්නේ ඉන්දියානු ටොයිලට් එකකට ඇදලා ඉන්නවා. ඒකේ ඉන්නවා. ඔක්කොම වනසන හදිස්සියේ මයිකේ hello
Hi again. Hope you can hear me again. Can you all hear me?
Yes, sir.
Hope you had some kind of a tea or coffee or a short break, which is really important, I think. Especially when you hear for the same tone for about 6 hours, right? Not easy to cope up, especially during these online sessions. Do you all have online lectures? Or do you have physical ones as well? Is it all online?
Yes, sir. We have lectures online and exams physical.
Right. So we will not have then any physical appearances, meetups. Right. I think we can start. We have about an hour to go, and let's see how long we could take this. Now we are coming to the financial accounting segment. I would say this is a very important segment. And it starts with this entity concept. Let me ask you this question. Have you ever heard of this concept, entity concept? Entity concept? Yes or no? No? Haven't you heard about the entity concept? Any one of you? No. If not, I will explain it. Right. Entity concept is a very key concept in accounting. And it says owner of the business and the business are two separate entities. Let me repeat. Owner of the business and the business are two separate entities. So when it comes to accounting, we prepare our accounts for the business and not for the owner. For the business, we prepare our accounts for the business and not for the owners. So owner of the business are separated from the business. In accounting, a business and its owners are treated as two separate identifiable parties. That is called entity concept. So there is a business, there are owners, but they are two separate parties. Now, if I draw here, I'm not sure whether I can draw. Now, this is the business and this is the owner. This is the business and this is the owner. But they are two separate parties. Two separate parties. It's the business. Okay, I don't know to get rid of that. Okay, let's forget about it. But owner of the business, the simple term is that owner of the business and the business are two separate parties. And in accounting, and Sales. Right. Got it. We treat them differently. In accounting, we treat them differently. Let's start with a simple accounting transaction. Let's start with a simple accounting transaction. I would wish to interact with you all here in this. Now, as we said, we are going to open a pizza shop. Let's say Pizza Hut. We are going to start a Pizza Hut. And I am the owner of the business. Let's say owner. Let's say owner is Chatura. Not me. Owner is Chatura is going to start this pizza shop. And for that, he will invest, let's say, 15 lakhs. He will invest 15 lakhs. Or we can say invest 15 lakhs LKR. Now, owner is Chatura. And Chatura is investing for this business, pizza shop, 15 lakhs Sri Lankan rupees. Now, as I said, we prepare accounts for the business and not for the owner. Okay. Now, we need to think in terms of the, business. We need to think in terms of the business, not in terms of the owner. Because owner and the business are two separate parties. So we need to look at from business point of view. We need to look at from the business point of view. That is very much essential. Right? Now, when it comes to business, tell me, do they have an asset with them now? Business? What do they have? Now, Chatura invested 15 lakhs for the business. Now, think in terms of business. What do they have now? They can have assets. They can have liabilities. They can have income. They can have expenses. They can have equity. Okay. Now, I want you to answer. Now, from business point of view, what do they have at this point of time? Out of these 5.
Assets of 1.5 million as cash.
Sorry. Can you repeat? That's correct.
Asset of 1.5 million of cash.
Yes. Brilliant. They have cash. They have cash. $15 lakhs, 1.5 million cash they have. That's great. Okay, you said assets, right? Right. They have assets, and one type of asset is cash, and the amount that they have is 1.5 million. 1.5 million. So they have, business is having now cash 1.5 million. Okay. What else they have? Oh, business. What else they have? Just think. What else they have? They have something else as well, apart from this 1.5 million.
Equity of 1.5 million.
Equity of 1.5 millions. How that come?
Equity is equals to assets minus liabilities. Liability is 0. So equity is 1.5 million. I don't know.
Brilliant. Equity. Equity of 1.5 million. And that equity we call capital. Equity capital. Equity capital of 1.5 million. And now we are redefining capital. Capital is the business's liability towards owner. Equity is business's liability towards owner. Now, we said a short while ago, owner of the business and the business are two separate entities. Owner of the business and the business are two separate entities. Now, think in terms of the business. I asked you to think in terms of the business. Now, owner is putting 1.5 million into the business. Now, business is having cash 1.5 million, as well as business is having a liability towards the owner. Liability towards the owner, because owner has put 1.5 million. Now, business is liable to pay that back, 1.5 million, to the owner of the business. And since it is owner's liability, we call it capital. We call it capital. Owner's liability towards the owner is called capital. Okay. Or we call it actually equity capital. We call it equity capital. Liability towards the owner is called equity capital. Is it clear? So business has now asset worth of 1.5 million. Business has a liability towards owner as 1.5 million, or equity capital of 1.5 million. So there are two different items. And we can safely say now, assets equals, let's take it here. Assets equals liability. Assets equals liability. Assets equals liability, or assets equals, sorry, assets, not liability, assets equals equity. Right. Now, Chatura now starting his business, and he realized that business need another 500,000. start its operation, 1.5 million is not enough. So he is taking a bank loan of 500,000 from, let's say, BOC, Bank of Ceylon. Now business is taking a bank loan of 500,000 from BOC. Business is taking a bank loan of 500,000 from BOC. Now tell me where that's going to affect. Again, there are 5 items: asset, liabilities, income, expenses, and equity. Tell me where that's going to affect. Business is taking a loan of 500,000. I want to raise your voice. Sorry?
The liabilities,
Liability, yes, yes.
liability of a company and his account.
Yes. Now company is having a liability. Towards whom?
Bank.
Towards Bank of Ceylon. So company is having a liability. How much? 500,000. To Bank of Ceylon, BOC. Now tell me, who is BOC? Now you know the accounting terms. Who is BOC?
Creditor.
Wonderful. BOC is our creditor. BOC is our creditor. Yes, that's true. We have a liability of 500,000 towards our creditor, Bank of Ceylon. Great. Is that all? Is that all?
Cash worth of 500,000. Assessing.
Wonderful. Yes, now business is getting cash. Now business is having 1.5 million. Now they are getting another 500,000 cash. 1.5 million plus 500,000. So now we can safely say assets equals equity plus liability. Equity plus liabilities. And we have cash now 2 million. We have equity capital of 1.5 million. We have a liability of 5 million. So now we have built something here, which is called accounting equation. This is the accounting equation. Accounting equation. Let's put a different color. Basic accounting equation says assets equals equity plus liability. Assets equals equity plus liability. And another thing, apart from that, you realize that, okay, when owner invest 1.5 million for the business, it got affected in 2 different accounting entries. It was affected to assets as well as it was affected to equity capital. And the second one, when the business received this bank loan, it also got affected in 2 ways. It got affected for cash and also it got affected for liability. So whenever an accounting transaction is happening, it has this duality. It has this duality. Accounting transactions affect two different accounts, we call it. Two different types of accounts, or two different, not types, two different accounts. It got affect. So that is the duality. So when investing 1.5 million, the duality is that you receive cash to the business, as well as you receive a liability for the business. So two dimensions. And when you, sorry, not liability, you receive capital, equity capital for the business. When you got a loan, you receive cash for the business, as well as you got a liability for the business. So every financial transaction could affect, will affect two different types of accounts. Is a duality concept, or we call it a double entry system. Double entry system. This double entry system is the one that was introduced by Luca Pacioli, the father of accounting, back then in 1494, in his book Summa di Geometrica di Arithmetica. Summa di Arithmetica di Geometria. So basic accounting equation is this. And according to this principle, we can enter any number of transactions. We can enter any number of transactions to this accounting equation. And interestingly, at the end of the day, you can see assets equals equity plus liability. Here, equity is the liability towards the owner. Liability is the other liabilities. Equity is the liability towards the owner, because business and the owner of the business are two separate parties. So when owner put some money into the business, business has a liability to pay that back to the owner. So it is the liability towards the owner. And for that, we don't call it a liability, because business is owned by the owner. So we give a, instead of calling that as a liability, we give a different term, equity capital or owner's equity capital, to segregate, to differentiate that from the other liability. But as you can see here, assets equals liability in a very straightforward manner. Assets equals liability. And we differentiate owners liability and liability towards others, or sorry, liability towards owners and liability towards others. So we say assets equals equity plus liability, equity plus liability. Equity is the liability towards the owner. Liability is, of course, liability that are not belongs to the owner. So this is the basic accounting equation, and this will continue until we complete financial accounting segment. And this will evolve, but we only have 5 different types: assets, liabilities, income, expenses, and equity. So the equation grows, but it can grow up until these 5 different categories. Good. Do you have any questions from this? We are coming to the real accounting, financial account. Okay, it seems you don't have any questions. Let's move on to the PowerPoint. Entity concept, we discussed owner and the business are two separate entities. In accounting, a business and its owners are treated as two separate identifiable parties. This is called the entity concept. And there are number of accounting concepts. Business entity concepts that we discuss, money measurement concepts, going concern concept, accounting period concepts, cost concept, dual aspect concepts, revenue recognition concept, matching concept, accrual concepts, objectivity evidence concept. So I will give you my second assignment to you now. Can you remember my first one? Is to find an annual report and have a look. The second one, search about these accounting concepts and prepare a short note. Not difficult, just Google and find it. Search about accounting concepts and prepare a short note, handwritten short note. So even if you find things from Google, when you write it down, things will stick into your mind. Okay. And we will not touch every concepts in our classroom, but we will touch a few concepts. And when I say about it, then it will go to your memory better. If you don't make the short note, I don't mind, because if you make it, the benefit is not for me, but for you. Anyway, at the exam, not every concepts will be touched, but key concepts will be touched. I will share my insight around those concepts, but if you do these assignments, these are not the assignments that you will get marks as per say. For the assignment, you will not get marks, but at the exam, your answers could be much better with having the knowledge. So try to search for these concepts and prepare a short note. The whole purpose is to gain knowledge, not to test your knowledge. Fine. Accounting equation. The asset and the ownership of those assets of a business are shown in accounting records of that business. All assets should belong to some party of the business. Therefore, asset of the business should be equal to the total ownership of the asset. To show this relationship, an accounting equation is used, which is called as accounting equation. It all starts with asset equals equity. Now, Amal started a business investing 500,000 in cash. Here, asset of the business equals to 500,000, and this total amount belongs to the owner Amal. So assets equals equity, cash equals equity 500,000. When a business expands, the resources invested by owners would not be adequate. Therefore, the business will have to obtain resources from external parties, like obtaining loans. When the business borrows money, liabilities arise. When there are liabilities in the business, a part of its assets belongs to debt holders. That is, debt holders means the liabilities of the business. So not the equity holders, equity owners, not the owners, but debt holders. For in that example, bank. Remaining of the assets belongs to the owner. In such a situation, accounting equation can be built as follows: assets equals equity and liability, which we did. With reference to the above example, if Amal had to obtain a bank loan of 300,000, assets of Amal's business are increased by 300,000. So cash will increase by 300,000. On the other hand, liability, the bank loan will increase by 300,000. We all discussed this. Right. Now we need to build this accounting equation. The value of assets, liabilities, and equity are changed due to business transactions. Accordingly, the accounting equation changes due to business transactions. Let us understand these changes using following examples. Okay, now I want you to contribute here. So let's unmute and discuss this. Owner invested 800,000 cash as capital. Owner invested 800,000 cash as capital. So can you tell me where that's going to affect? Owner invested 800,000 cash as capital.
Equity, sir.
Yes, equity Equity capital will be 800,000. Okay. What else?
Asset.
Sorry,
Asset. 800.
I hear you from quite far actually, Anuradha, right?
Asset also 800,000.
Yes, asset, cash, right? So from business point of view, now business is getting cash 800,000, which is an asset. And business is having a liability towards owner now, 800,000. So that is owner's liability is called equity capital. That's fine. Then the second one is business is now purchasing furniture. 100,000, 1 lakh. So now what would happen? Purchase furniture.
Expenses.
Expenses. Okay.
Reduction of current asset and increasement of non-current asset.
Can you explain that a bit, Pumali?
Current asset in the sense cash in the hand get reducted, and with the money we are purchasing furniture, it is can consider as non-current asset. It is the increase
Yes.
of non-current asset.
Business is getting the furniture worth of 100,000. And also business is losing some cash, 100,000. So furniture asset increase, cash asset decrease. That is the duality. So it got affected 2 accounts. So double entry system. That's correct. We will write it in the Excel, but let's discuss the next one. Obtain a bank loan 300,000. Can someone tell that? Obtain a bank loan of 300,000.
Increase current asset as well as increase liability.
Can you explain that again? Explain that in detail.
In obtaining bank loan, the 300,000 rupees cash come into our account. It is current assets,
Okay.
and we are being liable to the bank to pay the loan. So we have also the liability increase. Bank becomes a creditor.
Absolutely. So any one of you have any different viewpoints here? No different opinions. So let's try to put that here. We can use the same. First one, owner invest. Now we can use this one. Yes. Or probably let's create a new one here. We have this accounting equation with us. Let's copy that. Assets equals equity plus liability. First one is investing 800,000 cash. So we need to think from a business point of view. Business point of view, that's very important. So business is getting cash. Business is getting cash, 800,000. Business is getting cash, 800,000. And its owner who is investing for this. So it is capital, equity capital of 800,000. Equity capital of 800,000. So you can see assets equals equity. Assets equals equity. That is the first transaction. And then the second transaction, purchasing furniture by spending 100,000, purchasing furniture by spending 100,000. So business is getting some furniture. What is furniture? It is an asset. It is a non-current asset. Now, cash is a current asset. And now we are getting furniture. Furniture is a non-current asset. It is a, let's say, non-current asset. Or we can insert a new row. Furniture, it's a non-current asset. Cash, it's a current asset. විහිදව බලන්න. Right. Now we got furniture to the business, and that amounts to 100,000. We got furniture that amounts to 100,000. And it affects our cash. So we paid cash 100,000 to get the furniture. So our cash will reduce by 100,000. Cash will reduce by 100,000. And there will not be any impact for our capital, no change in the capital. Capital will stay as 800,000. So now if we look at the totals, we can put a sum here. It's 100,000 and yeah, no change in the capital. So you can see total assets equals equity plus liability. Total assets equals equity plus liability. Okay. Let's do like this. Right? Total assets equals equity plus liability. And there is the third transaction. That is, they're taking a bank loan of 300,000. Bank loan of 300,000. That means our total assets will increase by 300,000. Total cash will increase. Cash asset. Total cash asset will increase by 300,000. And also now we have a liability towards Bank of Ceylon or bank, liability towards bank, 300,000. So there is a liability towards bank, 300,000. And now you can see when we get a loan, the cash balance of the business increased by 300,000, as well as liability towards the owner will be created or increased by 300,000. And furniture, there is no impact with that transaction. And also equity, there is no impact. And you can see your total assets equals total asset equals your equity plus liability. Total assets equals equity plus liability. Now we can enter 1001 transactions here, but total assets will be equal to equity plus liability. Equity plus liability. So that is the accounting equation. Do you have any questions around this? Is it clear how this duality is happening? Is it clear? So silent.
Yes, sir.
Anyone else? Anyone who want me to explain it again? No, it's very straightforward. Great. Now let's discuss this and wind off for the day. But we will discuss this. And I want you to unmute and say your opinion. Nisal Mendis started a business to repair computers. Nisal Mendis, not Kusal Mendis, Nisal Mendis started a business to repair computers. The following transactions are given to you for the first month of the business. For the first month of the business. Owner invested 500,000 cash as the capital. Owner invested 500,000 cash as the capital. So can you tell me where that's going to affect? Now I want all of you to unmute. Where that's going to affect? Owner invested 500,000 cash as the capital.
Assets.
Okay. Please explain. Elaborate.
It is a cash. That case, it is a asset 500,000, and also it's a equity as a that amount.
500,000. Brilliant. It's the same, right? Cash 500,000. Cash is an asset. Cash asset 500,000 and equity capital 500,000. Great. Then obtain a bank loan 200,000. Obtain a bank loan 200,000. What is that? I want someone to explain.
Cash asset 200,000 increase, as well as liability creditor increase by 200,000.
Brilliant. Yes, business is getting cash and cash asset will increase by 200,000. At the same time, business is now getting a liability. So bank or the creditor will be now 200,000. So again, if you look at the equation, one side cash, the other side equity and liability. So you get cash into one side, liability into other side. So equation get balanced. Third one, deposited 100,000 in a fixed deposit account. The different one, right? Can someone explain that?
If the fixed deposit is more than 12 months, it can count as a non-current asset. So the current asset reduce and non-current asset increase by 100,000.
Fantastic. Now, they deposit 100,000 into a fixed deposit. So your cash will get reduced by 100,000. Your cash account will get reduced by 100,000. And cash asset will get reduced by 100,000. And another new asset, fixed deposit asset, will be created, and the amount is 100,000. So one asset increase, another asset decrease. Or one asset is created newly, another asset decrease. So that will nullify the total asset amount. Okay, so means the accounting equation will get balanced. Yes, fixed deposit is more than, let's say if it is more than 1 year, non-current asset increased by 100,000. Current asset, cash current asset decreased by 100,000. Fixed deposit, non-current asset increased by 100,000. Great. Fourth one, earned a cash income 60,000 from computer repairs. Now, there is a cash income earned 60,000 from computer repairs. So you have provided a service. Now you are getting an income of 60,000 in terms of cash. Can you explain that? Can you explain that?
Cash asset increased by 60,000. New income increase as 60,000.
We have not discussed income and expenses yet. So increase in income will increase the equity. Let's say so. Increase the income will increase the equity, because increase in income means it will increase owner's profitability. Okay. So here, for the time being, we can say cash asset increase by 60,000. That is your left hand side, cash increased by 60,000, and your right hand side, that means that income belongs to the owner. So owner's equity increased by 60,000. We'll come to income and expenses in the next section. Great. Then the other one, paid 10,000 as monthly rent of the business. So what that could be? Rent payment of 10,000.
Reduction of cash asset by 10,000 and
Yes.
reduction of liability by 10,000.
Liability. Did we have a liability?
Isn't the rent person is a creditor?
No. It is an expense. Rental expense means reduction in the equity. Now, in the earlier one, when we receive an income, we said increase in equity. Okay. So this is an expense. Ideally, we should create an expense account, but we have not touched expenses yet. So let's decrease. It's an expense, right? When we increase our income, we increase our equity. Now, when we have an expense, that will decrease our equity. So here you are going to lose money. So cash asset, one side, your left side will decrease. And your right side, equity also will decrease. Owner's profit will decrease with the expense. Owner's profit will increase with the income. Owner's profit will decrease with the expense. So decrease in equity. Then Nisal Mendis, owner, withdraw 20,000 from the business for his private use. අන්න අලුත් එකක්. Owner withdraw කරනවා business එකෙන් සල්ලි එයාගේ පෞද්ගලික පරිභෝජනය සඳහා. And it's very important, owner and the business are two separate entities. How do we record that? Can you repeat? I hardly hear you, Dilani.
Cash reduces by 20,000 and equity also decreases 20,000.
Absolutely correct. Yeah, when owner is withdrawing 20,000, your business's cash will decrease by 20,000. And when owner is putting money into the business, that is equity. And when owner is taking money back from the business for his personal use, that is the reduction of equity. So your cash will go down, your left hand side will go down, your right hand side equity will go down. And we give a special term for these kind of personal withdrawals. We call it drawings. Drawings. Owner draw money from the business. Owner draw assets from the business. So drawings. Drawings is the term that we would give. Then seventh one. Purchased equipment 100,000. Purchased equipment 100,000. Can you describe that? Purchase equipment 100,000. It's raining here.
A reduction of cash by 100,000 and increasement of equipment by 100,000. Both are assets.
Absolutely right. Yes, you get assets, non-current assets, 100,000. And your cash asset will go down 100,000. So one asset increase, another asset decrease, impact is 0. So both sides get balanced. Then paid 5,000 for the telephone bill expense. Paid 5,000 for the telephone bill expense. Now we have not touched expenses. Therefore, what we do? We reduce cash asset 5,000 as well as we reduce the equity because the profitability goes down, equity goes down by 5,000. So cash goes down by 5,000, equity goes down by 5,000. So the things will get nullified. Then the ninth one. Nisal Mendis invested an additional capital of 50,000. Now Nisal Mendis is investing additional capital. I mean, no difference, right? He's investing capital for the business. When he's investing capital for the business, it's capital increase or equity capital increase and the cash increase. Here, additional capital means cash will increase by 50,000 and equity capital will increase by 50,000. So both sides get balanced. And the 10th one, settled 20,000 of the bank loan. That one I want you to tell. Settled 20,000 of the bank loan. There is a bank loan of 200,000. Now he is settling 20,000. What are the transactions that could happen? Can someone say?
Cash
Deduction.
assets reduced by 20,000.
Okay.
And
Yes.
Liabilities also reduced by 20,000, non-current liabilities.
Absolutely right. So when you are settling, your cash is going to reduce by 20,000. Now you have a liability of 200,000, but you are settling 20,000. So liability will become not 200,000, 180,000. So liability will get reduced 20,000, cash will get reduced 20,000. So cash reduced 20,000 by 20,000, liability will get reduced by 20,000. Again, accounting equation will get settled. Fantastic. So now I want you to enter this in the accounting equation as a homework. So this will get expanded with different assets, different types of assets, different types of liabilities. But as a homework, please enter this transaction, these transactions in the accounting equation. And after every transaction, you will realize that accounting equation will still get balanced. That is the uniqueness. And every transaction has this duality, double entry principle, double entry concepts. It will affect two accounts, and that is the uniqueness in accounting. So there is a dual aspect and it affects two accounts. And once recorded, the accounting equation should get balanced. And I will send this to you, and please give me one of your email addresses. So I will send this PowerPoint slide deck. I will email this to your PowerPoint slide deck. Can you drop me an email address here? I don't have your email addresses. Please drop. I mean, if you have a coordinator, please drop right now so that I will send it today. So that person can distribute it to the entire class. Or do you have a group? Then that would be great. So my email address, I am sending kasun.aryadas@ifs.com or kasun.aryadas@gmail.com. So those are my two email addresses. I want your email address as well to send it to you all.
Right onto Lanavila Road, Wenapua Kirametiana Road.
It's thundering here. Can someone drop the message quite fast?
Take the next right onto Lanavila Road, Wenapua Kirametiana Road.
No one wanted to drop a message. Okay. I will send it to Rayli Mohammed. I will send it today.
Okay, sir. I will pass to the colleagues.
Please do.
Thanks.
Let me save that one. Yeah, it's thundering here actually. Okay then. So if you have any questions, please drop me a mail. I will try to answer if in the next class, or I will try to respond to your mail. And I think we are meeting in 2 weeks' time. Yes, that's how the schedule looks like because I can't take up all the Saturdays because of some of the commitments that I have. CSR projects that I do. So try to accommodate every other week, can take up 2 sessions. And thank you so much for interacting me. You all are great and you all are interacting well. And thank you for switching on the cameras and introducing yourself. But it's all about accounting. And if something is not clear, please raise, please ask questions, please clarify. Because everything is done through online mode, which is not my favorite, but have to stick with that with the current situation. So we'll meet you in 2 weeks' time. Thank you so much. Bye for now.
Thank you, sir.
Thank you, sir.
Thank you, sir.
Thank
Thank
you.
you, sir. Thank you, sir. Thank you, sir.
Thank you, sir.
Awesome.